Today we are talking about types of taxes. This can get sort of boring, but it is important to understand these things, particularly as you move into adulthood and you get out on your own and eventually you start paying taxes outside of just summer jobs. We're going to talk about almost each and one of these throughout. So move on to the first set of notes. Remember, don't pause the video. At the end of the 2 minutes, you can continue writing. I'm going to begin explaining what you see on the screen. Okay, well, if we were teaching like straight out of the textbook, it would be, we would be going over just individual types of taxes and moving through that. But in reality, what we want you to understand is like how taxes actually work in the real world. So when you have a job, every paycheck you get is taxes are taken out. So almost, majority of Americans, that's the way it happens. That's called payroll tax. So your employer takes out taxes for you, and then either monthly or annually, your employer will submit your taxes to the IRS and the federal government. So it's the idea that on April 15th, you pay taxes. For the majority of Americans, that's not the way that it works. Majority of Americans, you've already paid tax. So by April 15th, you want to find out if you have paid too much or too little. So if you paid too much, you get a refund. That's generally what most everybody hopes for and what a lot of people get. So you get money back from the government because your employer took too much out of your paycheck. Or you might have gotten a tax credit for that year and you're getting money back because you just bought a house or just bought a car, or depending on, you might have added to your family at that point, gained a dependent. So you're going to get some money back. There are on the occasion where, say, your employer did not pay enough taxes and you're going to have to make up that difference. It's not impossible, but it might happen. That's when you got to go to your employer and figure out what's going on. So also out of your paycheck, you have your Social Security tax, which is something that will benefit you later on, but it's really to pay for the current people receiving Social Security. And then with the idea that when you get older and you retire, or if something were to happen and you were injured, you have money from the federal government coming in to help you make ends meet. You also have your state and local income taxes taken out. So income tax is not something that is just federal. It is at the state and local level, but it's generally a smaller portion than what you would pay to the federal government. And then, of course, Medicare and Medicaid, which are similar to Social Security, but it refers to health care. Medicare for when you get older. Medicaid is that if you drop below a certain income line, then you qualify for Medicaid to help you with medical expenses. The other thing to know about income tax on what you earn, is so corporations are treated almost as individuals. And so corporations have to pay income taxes. Business have to pay income taxes based on the profits that they make for that year. So it's not, for instance, even if you own your own business or you are part of a large corporation, as the business itself, you have to pay income tax on what you make that year. So businesses are not exempt from taxation. But that doesn't always mean that corporations follow the rules entirely. So a way some corporations get around that is that they base their headquarters in a country that has lower tax rates, so they have to pay less on that. So when you have multinational corporations, and they're not specifically confined to the United States, they might set up all their business dealings in another country that has a lower tax rate than the United States. All right, last slide. Same as before. Okay, so real quickly, just to go over, I might get to each individual one here. So the other taxes that there are, meaning how the government generates money, whether it's your federal government, state government, or local government. So there is no federal sales tax, but there can be state and local sales taxes. So these are the taxes that are on things that you purchase at the store. So whether it's a bag of chips from the corner store or your groceries for the week from a grocery store, there's going to be a sales tax on it. So and that goes straight to your state and local governments. An excise tax is for big and fancy things. So if you decide that you're going to get a luxury car, there will be an excise tax on that. If you decide to get a boat, there will be an excise tax on that. So that's another way that taxes are generated. A consistent tax that state and local, particularly local governments use, is property tax. So if you own property, you have to pay taxes on that every year. So a simple way of thinking about this is that if you buy a car, you have to have it registered with the state, right? So either here in Louisiana, it can be like every 2 years, every 4 years, every 5 years. Whenever you re-register your car, you're paying a property tax for that car. If you own a home or you own any piece of land, you pay property tax on that, typically annually. And so that is a big generator of money for state and local governments. You also have an estate tax. So if, in this case, would be a tax on everything that let me back up a second. So estate taxes and inheritance taxes sometimes kind of blend together. But like an estate tax would be if you own a lot of assets, then there's an estate tax on that. So if you own different pieces of property, if you own multiple businesses, and even too, if you are part of generational wealth, then there will be an estate tax applied to the value of what you own. There's also, if you inherit a lot of money, there will be an inheritance tax, or sometimes they call it the death tax to scare people. And so if a family member passes away and they leave you a bunch of money, there will be taxes on the money that they leave you, because now all of a sudden your income has gone up. Gift taxes, if somebody gives you, I believe, if it's 14, or it changes depending on legal codes, but the textbook had an example. If it's over $14,000 a year, if somebody gives you an annual gift of $14,000 or more, you have to pay taxes on that, because that's a significant increase to your income. And then there's import taxes, or what we call tariffs. So if you are bringing goods in from a foreign country, before they enter the United States, you would have to, as your business, you would have to pay an import tax or a tariff on that. And generally that gets passed along to customers so that you can make your money back if you own that kind of a business. Now the main thing here, and I will try not to spend a whole lot of time on this, but is the difference between progressive and regressive taxes. The main thing here is who gets taxed more, and we're talking about percentages. We're not talking about flat fixed amounts. So if we say in general, on average, taxes are about 20% in this country, what that means, we have a progressive income tax system in the United States, meaning the wealthier individuals pay more in than lower income individuals. So we don't have a flat tax, meaning it's 20% across the board. But for example, if the higher income earners in the United States pay 20% on tax, which unfortunately they don't, but if they do, then the lower income brackets are going to pay a smaller percentage, maybe 10, 15%. So it's a lower number for lower income people, higher number for higher income people. That's a progressive income tax. Regressive goes the other way. So if we had the top earners in the United States were, say, paying 10% on tax, a regressive tax would then say 20%, or the low income people would be paying 20% of their money to taxes. Now, again, percentages would mean even if we have a larger number of lower income people and they're paying 20%, the reason we don't do a regressive tax is that it doesn't generate enough money to fund the federal, state, and local governments. That's why a progressive tax works better. Now, every year at tax season, so starting from the beginning of a new year to April 15th, if you pay attention to current events, there will be many news stories about how people like Elon Musk or Jeff Bezos, they don't pay anything in taxes. And these are very high income earners, or at least what we believe to be. But they know the financial system very well, whether they operate here in the United States or operate in a foreign country. But what they earn in the United States, they keep in areas that are non-taxable. So typically investments, like even just stock market investments, while you have money in the stock market, that's not really taxable income. Once you sell your stocks and pull your money out of the stock market, then that becomes taxable income. So if you have everything, and one of the phrases they use is like in liquidity, meaning it's moving around, then you can avoid paying high income taxes. So, and that's how these individuals, like just the two examples I made, they can get around to literally paying almost no income tax in a year because they don't actually have income. Everything they have is in investments. So if you do generate a significant amount of wealth later on, that's one way that you can avoid it. And as far as I can recall, it is completely legal. Okay, that's all we have for this lesson.